Alright, welcome to the accounting cycle. I'll be walking through each step thoroughly and explaining. Alright, so the first step is analyzing source documents. There are various different types of documents that will be analyzed in accounting. They include invoices, receipts, bills, payroll records, contracts, bank statements, such as the ones shown on the slideshow right here. The one on the bottom will be a credit card statement, and the one near the top, that is just a bank reconciliation statement. And then the one right below it is an invoice. So these are types of transactions that are analyzed in accounting. And it's also important that you check them for accuracy, make sure they have the correct date, the correct amount, description of service, and also determine the type of transaction. So next, the transactions are analyzed into debit and credit parts. So the debit part would include cash, accounts receivable, equipment, rent expense, salary expense. Accounts receivable is like when someone owes you something for you providing a service or a product. Rent, salary expense, pretty self-explanatory there. Credits would be accounts payable, like when you owe someone money. Sales revenue, so the money you make from your sales. Sales tax payable because you owe money to the government. Income tax payable, obviously kind of the same category, and mortgage payable. Alright, next is a very important concept in accounting, which is the accounting equation. This is the basis for balancing accounts and things like that. So on the left side, we have all the assets, which include expenses and drawing accounts, and that would equal your liabilities and equity. So what kind of stuff is in liabilities? Well, we have revenue, capital, and payable accounts and taxes. So this is all money that we owe, and then money we make from our business. And equity obviously just includes your owner's equity, so kind of like the money that you use to start up a business. And the left and right side will have to balance for this equation to work, which we will we will explain later on in the slide. All right, so next is recording transactions in our journal. So once we've analyzed our source documents, we're gonna put all this information in a general journal. So this is where transactions are first recorded. You have a general journal for all transactions, and specific journals for specific types of transactions, such as cash receipts, purchases, sales, and cash payments journal. So here's a little diagram below showing what accounts go up on the right or left. So you have two sides in your general journal or your accounting equation, right? So there will be debits and credits. So just a way to remember it is that debits will be on the left, credits will be on the right. Credits has R in it, which that's what the word right starts with. And then debits, that's just going to be the other side. That's kind of an easy way to remember it. So assets are normally on your debit side, which means they will increase on that side. And when you credit an account, it will decrease on that account. Expenses are also normally increasing on your debit side. So when you debit that account, it will increase on that side, but when you credit it, it will increase it, because credit is not the normal side it is on. Liabilities work the opposite way. When you credit liabilities, it's going to increase on that side, or it's going to increase that account, but when you debit it, it's going to decrease, and so on and so forth. So the next step is the journal entries are posted into ledgers. So after that transactions are recorded in the journal, they're transferred into the ledger or ledgers for these accounts. So ledgers are basically like a master list for each account, and they keep track of the final values, right? It would be kind of silly to have just a journal with all the transactions, because you wouldn't know the final value of the account. It wouldn't be extremely easy to track and have like a final statement, which we will get into later. And yeah, so they just keep final values of an account and all monetary information. And often journals and ledgers get confused in accounting. Transactions are posted in your journal first, and then they are recorded in the ledger. And journals record transactions in the order they occur, and ledgers just classify transactions by the account that they affect. So journals are more broad and ledgers are more specific. Again, with step 3, there are 3 main types of ledgers. You have your general ledger, which is for all your accounts, and then your accounts payable and receivable. That's just to track who owes you money and who you owe money. And our next step is scheduling our accounts payable and receivable which are prepared in step 4. So from the subsidiary ledgers of the accounts payable and receivable, again, these subsidiary ledgers are just created so a business can easily see who they owe money and who owes them money. So the information is taken from both subsidiary ledgers, and just as in the example shown, they are totaled, and this will kind of see if the business is doing well. Like, is this business having more income coming in than going out? And that's determined by this step right here. All right, next step, step 5, preparing an unadjusted trial balance from the general ledger. So once all the transactions are recorded for a fiscal period, whether that be a month, year, week even, an adjusted trial balance is prepared from the general ledger. So this is a snapshot of each account as it is before any of your adjustments are made. This, like I said, it can occur in different financial periods, and an example is shown right here. So you would list these accounts on each side that they normally increase on. So for example, cash will be on the debit side, and the accounts payable will be on the credit side, and these accounts are just simply listed so that you can adjust them later. So a pretty simple step. Next, the adjusting entries are journalized. So at the end of the fiscal period, there will obviously be a fluctuation in the amount of things you have on hand, right? Amount of items. So let's say at the beginning of the month you have like a box of crayons worth $5, right? At the end of the month, you'll probably end up using some of the crayons. Some might even get lost. So let's say it decreases to $3. So supplies would be on your debit side. So you would just simply credit $2 for the adjustment entry. So another example is shown down here. We have prepaid insurance. It was originally $900 at the beginning of the fiscal period. Insurance expense is the adjustment made, and what that does is it credits the prepaid insurance account. So then the new adjusted balance would be $750. Right? Next, the adjusting entries are posted to the general ledger. So after all these adjusting entries are made, they have to be posted back to the general ledger because the story has to be told in accounting, right? So we have to put it back into the general ledger so it can be seen so all the adjusting entries can be seen. So as you can see right here, so we made an adjusting entry to supplies, for example. We credited supplies because we lost $530 worth of supplies, right? Because supplies normally increase on the debit side, so we credited because we lost value in our supplies. So it goes back down to 90. And all the other accounts are adjusted, added up, and you make sure that each sides are equal to the other side because of the accounting equation. Right. Step 8, an adjusted trial balance is created. So once every account is adjusted, you prepare an adjusted trial balance. And this is simply just a list of every single account. Again, making sure that the debit and credit sides are equal to each other. Simply just for accuracy. And so financial statements can be prepared later on. This is also sort of just like a checkpoint in accounting to make sure everything's all good and everything's balanced. All right, so preparing financial statements. This is also a really important step because these financial statements are publicized and they're released to investors, the government, and stuff like that. So it's really important for a business to complete these. There are 3 important ones: balance sheet, income statement, and cash flow statement. The balance sheet simply just provides the financial position of the company. So this is really just comparing assets, liabilities, and equity. Income statement just provides a snapshot of a company's profitability, so money coming in versus money coming out and going out. And cash flow statement just tracks the flow of the money itself. All right. And here is an example of balance, income, and cash flow statement sheets. So once all the adjusting entries have been made and journalized, and the balance sheet, income statement, and cash flow statement are made, this is getting towards the end of the accounting cycle, and the closing entries are going to be journalized in this step. So when you close entries, it's really important that the temporary accounts are closed, and this is just so that you can reflect the true financial position. So for example, sales. Let's say a company has $1 million of sales in a year, right? And they don't close that account at the end of the fiscal period or fiscal year, right? Then they would start off the new year with $1 million of sales, right? First day, the first hour of the new fiscal year, they would already have $1 million in sales, right? That would be extremely silly, right? So the account has to be closed for the new fiscal year. And that's the purpose of the step. So often for this, contra accounts can be used to close out temporary accounts. Sometimes it doesn't work that way. For example, with sales, income summary is not really a contra account. It's just used to summarize sales pretty much. And permanent accounts are not changed. Permanent accounts would be something like assets, equity, and liability. So let's say a company has like cars that are used for its business, right? You wouldn't reset that account because the cars simply still have that value, and that's already taken care of with depreciation. Which leads into the next step. When the closing entries are journalized, depreciation is also taken into account. So over time, the equipment that a business uses will obviously deteriorate, and depreciation allows for a true reflection of an asset's value. And at the end of the fiscal period, it is closed out by the depreciation expense account. Depreciation will also be journalized, and accounts are closed for accuracy and comply with general accounting principles. The closing entries are posted to the general ledger, but permanent accounts are not adjusted, obviously. Those are just going to carry the same balance forward, and they're posted with the same amount. And the information is transferred in the general ledger by debiting or crediting each respective account, depending on their closing entry. Your accounts must have their accommodated balance updated. And an example here is that to close revenue accounts, you have to credit the revenue account and debit the income summary account, which is shown on the general ledger. This is again the same example that I used earlier with sales and income summary. This would be recorded in the general journal for step 11. All right, this is the final step. The post-closing trial balance is prepared from the general ledger. So the post-closing trial balance is just completed to make sure that all temporary accounts were closed properly and the accounts are ready for the next accounting period. This is, again, kind of like the last checkpoint in accounting, and this is just made to ensure that both sides of the accounting equation equal to each other. The post-closing trial balance should only include permanent accounts because all the temporary accounts have been zeroed out, so obviously they wouldn't be shown. And each permanent account is listed on each of their sides and make sure that they equal to each other. And that is it for the accounting cycle. Thanks for watching.